The Hedgeless Horseman here, it's November the 24th, 2023. I haven't done a video in a while. I've been busy with other stuff. Things to do, and also I've just, had my mind off the market a bit. It's like what I've been saying before. I mean, it's a waiting game. I mean, 95% of making money in this sector really is just waiting. I mean, even if you have what's going to turn out to be a really good story, let's say, typically it takes a year or two at least for a multi-bagger. There are exceptions, but to get a 10-bagger usually takes, I don't know, 3 to 5 years at least. I mean, according to Rick Rule, the average for his 10-baggers has been 5 years, which just goes to show, because, okay, you buy on day one or day zero, then you wait for 5 years, and then you might have a 10-bagger. And of course, like, the thing is, which I think a lot of people miss in this sector, where it's so typical that people take profits very early, is the fact that, I mean, if you're in the exploration game, it's a high risk, high reward game. Whereas, like, the chance of success might be small or making a significant discovery. Let's say it's 10%. So in that case, you kind of need, let's say, 2 in 10 to turn out well. If the other ones go down 50%, let's say 2 in 10 go up, 4x, 5x, and the rest go down 50%, or maybe more than that, or some go down, whatever. There's obviously a huge range of scenarios that could happen, but the thing is to get a 10-bagger, for example, to pay for a bunch of other companies that did not end up making significant discoveries. How long do you need to hold those? I mean, again, according to Rick Rule, it's 5 years. Maybe it's 3, maybe it's less. There are some that can pull a 10-bagger in very short time frame. But typically, I mean, I see a lot of postings out there where there's a 5-cent stock that this has gone up 1,000% or something in 6 months, and that can happen. The problem is that, like, typically the story was completely different at 5 cents. It's like Hercules Silver. Was that cheap when it went? I think it went down to 5 cents or something. It was probably cheap just based on the silver. But at the same time, I mean, the silver story wasn't that good that you're like, oh, of course this is a no-brainer buy, more so than anything else I can buy cheap. So it's very misleading. And no, it's not misleading perhaps, but when people look at it, it's like, oh, this junior is up 1,000% and I only am up 100% in that junior, whatever. Maybe you get in precisely when one should get in, because again, typically these stories that go up 1,000% in like a few months, several months, typically that's comes from a real surprise, that the story was almost over, almost dead. All of a sudden something positive happens that nobody could foresee. In that case, it's like there's nothing really to get upset for, because let's say there was someone who went super heavy in a 5-cent stock when everything looked crap, and then like some kind of miracle, they hit something substantial and you're up a lot. I mean, that was probably a bad decision from the beginning, to take huge amount of risk. Let's say maybe the company was close to bankruptcy with no real prospects at least, but they got lucky. You can't really replicate that. That's the problem. You can't replicate luck. The only thing we're interested in my opinion, is to have a solid investment philosophy or theory or strategy or strategies that we can replicate. We can't be just banking on luck, going all in on some 5-cent stock, and they just do something that 1 in 1,000 juniors do, and stumble across something really good, and then it goes up, because what that teaches you, even if you're the one that does that, you thought, well, this worked out, so that means it was a good idea, it was a good bet, and people would congratulate said person for it. But if it was just luck, it was just luck. It was not skill. It was probably a foolish thing to do. So I just, again, it's like we got to keep our FOMO and like envy in check. When you see a bunch of these juniors, well, I'm not gonna say a bunch, but some of these juniors, they're up a ton in a short time frame. But it's like probably very few were stupid enough to actually buy a lot of shares that low. Maybe they should actually have sold it at the lows, because there were other bargains around. Maybe that thing was cheap, but there were even better bargains around. So it was actually a mistake to be in it, but then they hit something and they got lucky. It's like Hercules Silver, for example, like I just said. Uh, that's up a ton from the low. So whenever that was, it's like, was it a buy at the low? Probably, again, just based on the silver. If you're banking on, well, the sector is going to turn around sometime, like it always does, and in that case, this might be a good bet. Silver in Idaho, probably really really cheap. So from that perspective, that might have been a good bet. But it's like, and I've said this before as well. I have warrants in Hercules at around 11 cents. They're over a 10 bagger already. But I take no credit for predicting that they would, possibly find a huge copper discovery that even, got Barrick interested. So I don't take credit for it, because it's like all I did was buy cheap in a private placement. That I take credit for, not the fact that it went up this much. I had no idea it was gonna they were gonna find what they found, etc. So you can't, again, you can't. Well, you shouldn't really. I mean, take too much credit for that, because if you take too much credit for stuff that you had no idea about, and just look at the results, and it's like, oh, what does that mean? I should buy every 5 cent junior or whatever? No, that doesn't really sound like a good idea in my opinion. So again, that's what I mean. We're supposed to be professional. So it's like, and I'm gonna get to that a bit later. Well, just to sum up, there's like, if you share your profits too much, you have to mourn your losses. Meaning, it's like, it's very hard to be emotional in one way and then not be emotional the other way. And as we know, emotions are bad across the board. I like the story about, I think Mike Tyson said it, that when he won his first professional match or something, he was very happy, jumping around, cheering, and his coach Castemato, the legendary boxing coach, told him, it's like, why are you celebrating so much? Why are you acting out? It's like, you trained for this. This is supposed to be business. This is exactly what you trained for, and now you're getting all emotional. I mean, some say it would be a good spot, or that he deserved to be very happy or emotional, whatever. But I mean, the what I think Castemato's intent was, or basically his intent was to cool things off. Like, no, you're supposed to be a professional. This is business. This is what you train for, and then you shouldn't go act surprised when it happens, and all of that. And of course, that might also eventually have led as well to, let's say he loses a match and he takes that very personal, instead of just, okay, another day at the office, let's go back to the drawing board and just train more. Maybe he would get crushed by a defeat or something like that. So I mean, that's the thing. If your highs are very high, your lows, and they're going to happen a lot in this sector, they will probably be very low as well. And since 80% of the time this market is cheap or crap or performing badly, there's going to be more lows than highs, or at least for a longer period of time. So I think it's just a bad idea from the get-go. It's like, I mean, I have a big position in Hercules, for example, but it's like I'm not out there cheering, really. I mean, I'm not really posting in the forum channel even, because it's like I want to also train myself to take the emotion out of it. Because if I start jacking up my emotions, then you're obviously emotionally invested. Your let's say ego gets involved, etc., etc. But you're supposed to be dispassionate when you look at these stocks. Okay, if you made a bet, this particular bet pays off, let's say. Should you really be surprised? I mean, that's what you've been planning for. That a few of these are gonna end up making significant discoveries. You're gonna be up a lot on them, and they're gonna pay for a bunch of losers. That's the job. That's our job in this sector, in this volatile sector. But if we cheer too much or whatever, then it's like it's almost like it's a big surprise, and that kinda I think signals unintentionally perhaps that it's like we don't really know what we're doing. I mean, I'm fine with being happy and cheerful and all of that. I should probably celebrate some milestones more myself. I mean, I don't think I did anything particular when I got up to 1 million Swedish kroner, for example. Even though that's even though the Swedish krona is worth a lot less than a US dollar, and still is very much today. That in Sweden that's a pretty big milestone because you're a millionaire. But I made no big thing about it because this is just a number. It's just a business. It's like it wasn't gonna change my life or anything like that. So maybe that's also I guess a key to my success, and I got that from poker. It's like you couldn't cheer too much, or you tried not to cheer or be too happy about wins, so you didn't take the losses too personally and become emotional, etc. Because you could not afford it. It was supposed to be a numbers game. You win some, you lose some. Back to the drawing board. It's just a win. Okay, win, check, next play, or next hand. But if your emotions go up, way up when you win a pot, and then way down when you lose a pot, obviously you'll be all over the place. And if you have a string of bad hands, for example, or you lose 3-4 hands in a row where you were a big favorite, if you take that very emotionally, like 4 times in a row, I mean that might end up crushing you. You go on tilt, and all of a sudden you start playing emotionally. You're gonna get the money back, and you're gonna punish the other people, and you're gonna try to beat them, and you just play worse. If they won with crappy hands, you're gonna start playing crappy hands because the universal law of justice should deem you to win 4 in a row as well with crappy hands. But it's like in the long run, it's a numbers game. So you should always, regardless of the results, you should stick to your strategy if it makes sense. And in that case, if we do that, we see it as a job, professional, then we don't really get too emotionally invested. And again, I think it's important not to take your wins too personal either, because let's face it, paper win or paper profits can disappear, and paper losses can disappear. So a lot of the time in this sentiment driven volatile sector, if you're up or down on a stock, it's just a function of time or where we are in the cycle. Same stock, if we were in a hot market, it would be trading at 4x what it's trading now. And we have no control of the emotions of the markets. So it's a lot of luck and timing in a sense, because if I look at my portfolio now, for example, and it's worth X, but it's like, yeah, one can say, it's like, are you happy? Let's say, are you happy with your portfolio? Let's say your portfolio is down 50%, and it's like, I mean, and in your mind, it's only a matter of time before you're up 300% at least from where you are, after you're down 50%. Then the question is like, are you happy about your portfolio? in one sense, on one hand, it's like, well, right now it's down 50% from the last high. So one can be, a bit down from that. But at the same time, same portfolio, you think that it's just a matter of time, maybe within 1-2 years, that is going to be up 300%. Same portfolio, it's just a matter of like timing, let's say. So I mean, you would obviously be happy with like what you own now. Sometime in the future, you think it's going to be up worth 300% more on paper. So from that perspective, you should be really happy about your portfolio because you know it's a ticking profit bomb, if you know what I mean. And that's the thing with paper losses and wins. But anyway, so I'm gonna go through a few things in this video. First of all, I'm gonna just lead here with like I'm seeing a lot of I look at charts now and then. Because like hate or love it, I mean the traders and most people look at charts all the time. I don't really buy or sell anything based on charts. I based on like what the price is today and what I think is going to happen in the future news wise. And obviously the longer ahead you can see news, the better, because nobody's pricing in that news today. I mean, if you think there's going to be a string of news items 6 to 12 months from now, I mean, nobody's pricing that in right now. If there's no news items, no exciting news items within the next 3 months, everybody will sell the stock. If there's a negative news item that people know is going to happen in the short term, people will have no problem selling it, regardless of how low it goes. Because it's like, when people expect really good assay results. No price is too high because everybody expects that when the assays are released, it's going to go higher. So who cares if it goes up 10% or 50%, whatever, because if the assumption is that whatever price it is at the day before the announcement, it will be lower than what's going to be after the assay results. By definition then, no price is too high. And the reverse also is the case, obviously. If the market expects that the next news item, material one, is going to be what the market thinks is going to be seen as a negative, no price is too low, because everybody assumes that regardless of how low I sell before said news comes out, it will be lower the next day. So there is no bottom in terms of cheapness, because all things are relative. And I think I spoke about this recently, that right now, for example, or at all times really, everything is made on a relative basis. Doesn't matter if something is cheap, if something bad happens, it goes down. And right now, even if something is, positive news comes out, maybe it doesn't actually go up, but it should already be up 100, 200%, but it doesn't even go up, even though now it should be up 250%. Or maybe that it goes up, but it doesn't go up anywhere close to where it's supposed to go up, yada, yada, yada. So everything is relative. Remember that. It's like, in the short term, especially at sentiment extremes, I mean, now it's a huge bias to the downside. So cheap tends to get cheaper, and a lot of things right now tends to be cheap. But anyway, so in my first article I did on Eloro, I just pointed out that, hey, this looks like it had recently broken out of a, I don't know what you call this, triangle, big triangle, I guess. I mean resistance line all the way from 2011, kinda. So it's like I just noted that it's like if because again, like always, even if you're not a trader, there are a lot of traders out there, so they might be looking at this, and they'll pile in. And as we know, most people are momentum investors, etc. So once the let's say the actual first buying comes from, what pushes it up comes from people that are fundamentally driven, then traders see that this is breaking to the upside. So regardless, so they don't even maybe think about the worth of the company or what the news really meant, but they start to get in because they see a break of a big a triangle, and sooner or later that's going to get the herd in because they see a rising stock price, because that's what they're chasing typically, and that's why these stocks go so low and they go so high, etc. Because at the end of the day, most people are momentum traders. If price was lower yesterday, or there's been a streak of lower prices, they're just gonna assume that it's gonna go down, and that's why they're selling today, so they won't have to sell even lower tomorrow. That's how people work, and that's how we all work. I mean, I find myself thinking like that. That's just how it is. It's FOMO to the upside, and whatever, the reverse to the downside. So I mean, in this case, for example, Eluro, it went on after it broke the trend line. It went for a 585% rip, and of course, like I also talked about before, and we're gonna get into this, that waiting for confirmation, whatever. It's like, oh, now it's broken the trend line, then I get in, whatever, and don't really know much about company. But let's say you had a due diligence edge. I mean, you actually cared about stocks. You looked into the companies, and you could kind of, let's say, I'm not saying that's the case with Elura, but let's say you could kind of foresee that, let's say when prices were here, you were kind of expecting, hey, I think there's a good shot that there's going to be some positive news coming that the market is not caring about right now, or it might be better than the market thinks or whatever. Then kind of you're front running. You think there's let's say a 50% chance that it's gonna whatever news you expect to come is sooner or later gonna break this trend line, and you bought in here. I mean, in that case, you would get a 1400% return. While the pure traders, let's say, they're waiting for a breakout, maybe they get in here when the candle closes above it, so they get 484% if they held it all the way to the top, which obviously is not a guarantee at all. But just think about stuff like that. It's like, this would obviously pay for like almost 3 times as many stocks like this rip would have paid for. And that's why, in my opinion, and I'll get to that later, I cannot afford to wait for people to say we're in a bull market. When the bull market is evident to everyone, then even if there's a good rip, you get maybe 200% in the last stages. I mean, some of the early birds, they get hundreds of percent more, 1,000%. That's the thing. It's like, okay, let's say the trade-off is that, well, at least I don't get to have many periods like this where it's like trades down and then just churns, etc., and you feel like an idiot, whatever. Sure, but that's the trade-off. I mean, we trade pain and boredom for larger absolute returns. That's how I view it, at least. That's why I keep on saying it's like the my memes with buy low and hodl and all of that. I mean, that's the price we have to pay, because everybody and their mother is waiting for the bull to be confirmed. Everybody's trying to pick a bottom or win a bull. Is the bull starting? Or win a bull yet? Everybody's waiting for when, because nobody can stand having paper losses, especially not significant, and especially not over a long period of time. Their ego can't cope with it or something. I don't know what it is. But there's also a saying, I think, from psychology, there's like, people will do more to avoid pain than to gain pleasure. So paper losses hurt even more than the wins feel good, if that makes sense. That's obviously a psychological edge we can use in that case. If we know that is the case, then if we're strong enough to not have that bias, that we're biased against paper losses, that we care more about not losing anymore on paper than actually making long-term returns, that's an edge. That's an edge right there. But again, that's why is it hard? Because it's emotionally hard. That's why most people won't make it in this sector. They can't stand the pain, which is really, the recent pain is the future gain. That's how it is. But I don't know. Most people, vast majority, don't see it that way at all. And of course, now we've had a retracement, and here you have a very, very long, frustrating consolidation phase. Actually broke down here. It's like, I'm a bit surprised that it's actually down today. But it also shows, I mean, just being early, it's like if you buy all stocks after the big run up, it's like, yeah, I mean, sooner or later there's going to be some kind of consolidation, because if this just kept on going like this, I mean, already in, what's this, like 2022 July, I mean, it would be up 15,000%. I mean, it's just unrealistic. But that, it always feels like that. It's just gonna keep on going. And we have no idea how this plays out. I mean, Elora, for example. I mean, I think it's worth more than the price is right now. I mean, but the market obviously, I mean, here it might have priced in too much. Maybe here it's pricing in too little. But it makes sense given that we're the sentiment low. But anyway, so yeah, I went through a lot of things there, I guess. And this is just also to highlight what I mean about, you know, to catch the full bull, one must invest when everyone is sure it's still a bear. And I've talked about this a bunch of times, but it's like I get emails and comments again from people. It's like sometimes I wonder, you know, given the amount of videos I put out, and I actually emphasize, you know, how you should play the cyclical mentality. One second. How a cyclical sector works, and it's just a matter of time before the bear dies, and then it's just a matter of time before the bull dies, and yada yada yada. And people still, you know, message me or whatever. It's like, you know, did something happen with this stock or that stock? And it's like, hey, if there's no news out, look at where we are in the sector, and it's bias to the downside. The market is full of shit. I don't take the market seriously, and I don't think you should. I mean, I know there's a lot of people who think the market is totally efficient and rational. I mean, that's probably because they can't beat it, and they just assume it has to be because of that. But obviously, it's hard to explain a short like this if it was rational. I mean, in that case, the market would be extremely wrong that it didn't price in that that it was going to go down 93% in just a few months and then go up 2,000%. I mean, what's rational about that? That's like, you know, I don't know, you know, black swan event times whatever. It's like first in one way and then in another way. I mean, obviously it's not rational. Makes absolutely no sense to have a stock price trading like this. Unless it's from humans. Trend followers, like always, down here. I mean, here everybody and their mother could see this was a bear market. Could they see this was a bear market, or was you were in a bear market here? I mean, in hindsight, we know the bear market started here. This was the top. We're already in a bear market here. How many would see that? Not many, right? Most people were still convinced it's a bull. Maybe, okay, and here we have, it's like, yeah, okay, maybe when it broke here, people were like, yeah, maybe it is actually a bear market. But there's been, you know, this was, I guess, a pretty nice retracement. I mean, this is a 46% dip. Why wasn't this a false rally, let's say, and a 46% dip is just, I mean, that it was going to do the same like it did here, keel over and then keel over and then keel over, you know what I mean. My point is that the longer a trend has gone on, and we know that every bull dies and every bear dies, so the longer this bull, the longer in age this bull, you know, is, it's obviously closer to its death, end of its life. But here is where everyone is convinced we are in a bear market. Everybody can see it's a bear market. And everybody hears that you should always, I mean, everybody's waiting for a bull market. Everybody says, oh, you know, I want to invest in a bull market. That's what everybody keeps on saying. And you see it all the time. When's the bull starting? When's the bull starting? When's the bull starting? Everybody's, you know, focused on if we are in a bull or a bear market. But if you take that in practice, like, why wasn't this the start of a bull market? I mean, made higher low, higher high. Boom. So if you waited for the bull market to start, again, for the coast to be clear, maybe it's a bull market. Okay, you bought here, or you bought here, whatever. It's like worst entry since here. And you would have lost, I don't know, how much is this? 76% in just a month for waiting for the bull market signal to be there. And again, the epic 2016 bull. When were people sure it was a bull market? I don't know. Maybe after this arbitrary line here got crossed. Let's say that was when people were kind of convinced. And again, like here, this rally broke the trend. So okay, here broke the trend, ran for 283%, and that ended up being a false rally. So how easy is it to know when a bull, if we're in a bull or a bear or whatever? It's damn hard. It's damn hard. And if this, as it turns out to be, was not a false breakout and then it keeled over, made a lower low, then to the top you made 187%. Like, congrats. Okay, you got in. It ended up being a bull market, so it kept on going. You got your 187%. But again, if you want to catch the full bull, you can't wait for a bull market. You can't wait for someone to call this a bull market, because then most of the gains are already over. Take this for example. I mean, when was this considered not a bear market? I mean, if you just cut the chart here because we don't know what happened after, why wasn't this just a lower high and then it went down here and then went down there and went down there? When were people really convinced it was a bull market? I don't know, when this line broke, or this line broke, or maybe when it made a high here or a high here and whatever, and went on higher. So maybe from here, that's a 318%. That's great in whatever, like 2 years. And even this reappears like 130% in just several months. I mean, that's great. But the ones who didn't even wait for anybody to call this a bull market and bought when everybody was completely in agreement that this was a bear market would be sitting at 1,300%. I'm not saying that they needed to buy in there, but if they started wherever and then just averaged down, if they had an average down here, that's still 600%. So if you wait for everybody to say it's a bull market and you're in a bull market, then the big gains are already gone. If you want to catch the full bull, you have to invest when everybody agrees we're in a bear market. Think about that. If you see a bunch of people in agreement, almost everyone in agreement that we're in a bear market still, that's a very, very good sign. That means that the full bull move is still left. If half the people are kind of thinking that we're in a bull market, maybe half the upside is left. If everyone agrees and it's obvious we're in a bull market, maybe there's, 70% left to the upside before the bear starts, before the bull is old enough, it dies of old age, and the bear starts. And of course the opposite is true. If everyone agrees we're in a bull market, it's probably time to sell. Because if everyone agrees it's a bull market, everybody's in. There's no money on the sidelines. Valuations are probably stretched. Somebody's going to start taking some profits. Somebody's going to start needing some money. Some selling starts. And there's nobody to pick up the slack because everybody's all in. So it's only a net drain from here. And then a trend forms, and that gets the trend followers selling. And then you have the ending washout kind of thing. And here we have the blow off. So it's perfectly fine. It's great. If you want the biggest absolute returns, or I should say, if you want to catch the full bull run, you have to invest when everybody agrees we're in a bear market. If you can't even see the bull, the darker the bull looks, or the farther away it looks, that's a very good sign. Imagine how dark it felt down here. You see this trend. Lower lows as far as the eye can see. And in the end, didn't matter if you started buying here or whatever, as long as you average down. If you average down here, you would still have big returns than the ones that actually just caught the half the bull phase when it looked, it's like it's probably a bull. But other times, said people will also get in here when it looks like it's probably a bull and get their legs cut off. Whereas if you're still only more value invested focused, so you look at valuations. You look at what the price you can buy these assets for, all the future news releases for. So if that's what drives you, you'll end up buying more the lower it goes. So you'll lower your average more and more. And that's why I also say all the time that around here, buying is exponentially better than holding. Holding is exponentially better than selling. But people, and I said this a bunch of times, people think that if they have just the strength to hold these lows, then they pat themselves on the back. Well, I'm buying all these lows. Our portfolios are not going to look even remotely close. And I've been I'm buying every month. I've been buying every month since here. And now I'm like all in as always. I mean, as all in I can get. And I believe me, I'm putting all the money I can into the market. I haven't seen prices this cheap in a very long time. But our portfolios are, or if you have a person who sells out his juniors around these lows, compare that portfolio to somebody who holds at least, but then compare it to somebody that buys the extremes, the extreme lows. Every single portfolio is going to look worlds apart. Maybe the one who sells his portfolio is down 70% and will be down 70% because he's going to find something, another hot sector, which is where the bull is old, and he's going to get in here and get another 70% minus, and eventually just stop investing. The one who holds, I mean, he'll get maybe a decent return. Who knows? I mean, in a stock like this, the longer you hold it, you kind of ensure you'll at some point at least be in a loss, because the dilution and a pretty lackluster company, let's say. But of course, you have the extreme rips in between, so you can make money on a trading sardine like this as well, if the sardine is still around for the next turn. And then compared to the people who, when the price goes lower, they ramp up their buying. I mean, they're gonna blow away the holders, the one who just held at these lows, by a mile, and especially over the long term. Just to make some other, I guess, points here. This is First Majestic. I don't know, it's just one of many charts I thought I would look at. Like, again, so this was the 2008 bear, which is this thing here in Bear Creek. When should you buy? When is the coast clear? You're down here. You're probably thinking we're gonna get down and fill this gap or whatever. I have no idea how the story was back then, but let's say, I mean, are you comfortable buying here? No? Okay. Are you comfortable buying here after it's gone up and turned down? Probably not. When do you think it's a bull? When are you convinced? A lot of people are probably convinced it's a bull here. That's a 464 return. It ended up being the continuation of a bull. And in hindsight, again, we know the bull started here. Here, well, up here, because we didn't know it was a bull until it like ran maybe, I don't know, up here or whatever. Because if it would have gone here and turned around, obviously this might not have been the start of the bull. So maybe up here we're convinced that the bull actually started here. So confirmation maybe comes around here, that we should have bought way back, and this way back when, down here. Think about that. Again, almost everyone is a hindsight investor. It's like, oh, I should have bought or whatever. It's like, it's the future that's all that matters. We need to be thinking about the bull in the bear. That's what I'm preparing for. I know we're gonna go into a bull. That's why I'm not worried. That's why I don't spend too much time just looking at the markets. I've actually been playing some computer games lately because I get so bored. I know the only thing to do is do the due diligence, put yourself in the best position you can. I add as much as I can, and then wait until we have one of these rippers. When the bull starts, the bears died. But yeah, just compares. Like this person here, obviously here everybody was convinced we were in a bear. I mean, it's just the conviction that we're in a bear. Where is it? It's going up like this when price goes like this, right? Makes total sense. Down here, the bears had gone on for the longest time it would go on, and at the lowest price. So everybody was convinced. It was obvious that we were in a bear market, let's say. So when everybody's convinced, when all evidence is there that we're in a bear market, when most evidence is there, because up here it wasn't evidence enough that the, let's say, bull was dead, or at least for a while. Here, it's starting to look like a bear market. Okay, it's breaking those. Now I'm sure it's a bear market. Okay, we broke these levels as well. And now we only have, I don't know, let's say, well, I guess there's kind of support here, whatever. But it's like, it had already broken like 2-3 supports or whatever. So what makes you think that people are going to think that this will end? No, then people are probably, again, going to look for the lows or whatever. So here people are very aware that this was a breakdown and we're in a bear market, let's say. Most that it's ever been, at least, or in hindsight we see that it's ever was. And compare that to the ones who buy when let's say they get in here and get 443, or the ones who like now they're pretty sure it's a bull, or maybe when it let's say when it crossed these two, the double top here, for example. So maybe they're convinced it's actually that this was the start of a bull up here. So they get their 250% return if they hold on long enough to see the top and not get shaken out in the meantime. The ones who invested when everyone was sure we were in a bear, 2,600%. Think about that. How much certainty do you need that? How much is comfort worth? And there's also the instances of false comfort. You just bought higher because it looked like prices were going to go higher, that the bear was dead. That was the worst possible buy since, well, this was the quickest loss of paper money, quickest paper loss since this period here. Think about how double-edged that sword is, to wait for the slash confirmation. Whereas, and this person, given how extreme, how an extreme amount of money this guy would have gotten, regardless if he started buying here, there, or at least at the lows. Imagine what kind of low chance of success you would require for this to be. If you think this has in this case, if there's a 5% chance this might be close to the bottom. 5% that we would be around some kind of bottom. That would be, in hindsight at least, a good mathematical bet. Whereas in this case, if you buy in here or here after it crosses the double top, I mean, you took this might have been a false. I mean, obviously valuations are much higher here than here. So valuation-wise, you're taking a lot more risk, bigger shoes to fill. And even in this case, when it was the bull continued, you got 232%. But you also risk this being a false, let's say, breakout to the upside, and a false rally or a false breakout, and you would, let's say, go back here and then lower, and you would shave off 50%. Is that, I mean, how nice is that? How asymmetrical is that risk reward? Whereas if you buy something dirt cheap, it's like, I think someone had a quote from Rick Rule that he had like 2% in silver juniors. And like he said that either that 2% silver junior position is going to be worth 1% or make up 1%, meaning either it's going to be, who knows, cut in half, or it's going to make up 20% of his portfolio. That's a symmetrical risk reward. That's what people don't get. They are looking for certainty. They're looking for, if they think they have some kind of profits coming in the short term, and who wouldn't if you see this kind of near term performance, that's what people care most about. And that's, again, going back to psychological factor. People are most afraid of paper losses. That's what everyone fears. Top priority, avoid paper losses. It's in any time frame, number one priority. And that's why nobody buys these cascading crash events. And the ones who do it, sometimes they need to be right one in, I don't know, 20% of the time that they're even close to a bottom or something. I mean, literally, if we go back and just look at the 100-year BGMI or whatever that index is called, if you started buying anytime the mining sector was down 50% and just kept on buying, as long as, you just automatically kept on buying the lower it went. You would have made money every single time. Let's say you started buying when it was down 50%, kept on buying every month. Ideally, you would increase your buying even, but still, let's say you have a steady stream of deposits every month, and you stop buying until, let's say, the price has gone up to, let's say you start buying here all the way down, and you stop buying when it's reached this or whatever, and then you would buy more, if it goes lower again. It doesn't matter the way the index really goes. You would have made money every single time if you just bought the crashes. And how many people out there are bitching and screaming right now and crying right now? Whereas this is literally why one can make a lot of money in this sector. When everybody is sure, it's clear as day that we're in a bear market. The clearer it gets, the better the buy becomes. The older the bear gets, the closer it is to death. Even though, for some reason, the older the bear is, the more convinced people get that it's immortal. This time it's immortal. Whereas in reality, we know that the longer the bear goes on living, the closer we are to the next bull, because every single bear dies. And if it's long in the tooth, it means we're getting closer and closer to it eventually dying. And the closer we get to it dying, the bigger, the again, full returns are going to be. Because you can, again, what I want to leave you with is, if you want to ride the majority of a bull, you have to invest when you know it's a bear market. Think about that. Because everybody else is obviously looking to put money where in what is a bull market, and you can see that. Just check Twitter. Everybody's asking when the bull is gonna start. Everybody's sitting on the fences for when the bull is gonna start. And who knows, maybe you'll have instances like this, for example, fake bull, worst possible time to buy, boom, slammed. Same here actually. I thought this was the start of the bull. Thankfully, I had, I'm averaging down all the way, so it doesn't really matter to me. Yeah, it's frustrating in a sense, but I just know I'm gonna make even more money. The longer the bear gets, the more ridiculous the prices get. Long term, I'm gonna make even more money. And I've said this before. If this was the start of the bull and we went like this, I would have made less than if the bear was even worse, went even lower. Because in the meantime, from here to here, I would have invested even more money, lowered my average even more, got more time to look at the positive news items from company, and like an insider get to appreciate, okay, I think they added 50 million in value, the stock didn't go up even 1 million in price, this just became a better bet. Okay, now I know, now that's an even better buy, I'm gonna make even more money on that, probably. I mean, I'm speaking in averages here because I don't expect every single case to play out well. But you get to see the cards get laid face up, and you don't pay for it. It's like in poker, if you get to see the next cards without paying for it. Obviously, you can make much more informed decisions. If you're going for a flush, next card is a flush, and you don't have to pay for it. You get a winner, or you at least have a flush on your hands. Of course, you're gonna be betting more money on that hand, because you hit your draw, and you didn't have to pay for it. You can just simply bet after the fact. And still, people bitch about this sector. This is like free money. It's like being an insider in this sector right now. In most cases, there are some who get appreciated for the positive news. So in that case, yes, it's actually does revalue. So maybe it opens up 30%. So in that case, holders from the previous day get a patented 30% return. Sometimes the holders gets nothing even though they take the risk. Because the news is, there's a risk the news is bad, but if the news is good, they get nothing for it. So at face value, they took return-free risk. But as a buyer, that's perfect. We're getting risk-free returns or risk-free value, and that's the secret. It's like I'm always all in. Okay, how can you always be all in a shitty market? Well, I get to see hands being turned up all over the place, and prices doesn't change, or maybe price goes down too much. So yes, it sucks from the perspective that my portfolio is I'm always a holder since I'm all in. But as soon as I sell something and buy something that's even cheaper, I also become a buyer. So I'm 100%. Let's say it's 100% rigged against me. But if I use the fact that it's rigged against holder and act on it and also become a buyer, then I'm always 100% a buyer and always 100% a holder. So they cancel each other out. If you understand what I'm saying here. But if you neglect that, if you just think the market is always right and you throw up your hands and you're like, oh, well, screw this sector, nothing works. And you're like, okay, this stock didn't go up on that or whatever. This sector doesn't work. I'm going to go find another sector. You don't act on the increased price to value gap. Then there's no wonder you're never going to make any money. Because you believe the bullshit that the Mr. Market is telling you. And you believe that this is a good time to buy because the market is always right. Well, it's rational, it's efficient, it's supposed to be up here because it is up here. Until it's down here. So how wrong was the market in that case? And down here, well, it's supposed to be down here because the market is right. Well, the market obviously didn't price in the fact that this very security was going up 2,000%, and the whole sector went up 1,000%, or a bunch of juniors at least. So the market was just wrong across the board for 1,000%, and you call that an efficient market? No, you can't believe the bullshit. Mr. Market is completely a complete moron. Complete moron, especially in this sector. In a volatile sector, Mr. Market goes from being a complete moron to the upside to a complete moron to the downside. It's just to say please and thank you. And everybody's waiting for the bull to get invested. I mean, they're going to be the ones that pay you off for getting in when everybody agrees it's a bear still. They have their place as well. Unfortunately for them, it's paying the early birds off. Yeah, so this was a much longer rant than I planned, so I think I'm going to cut it here and move on to some shorts in the next video. Thanks for listening. Consider me biased if I talked about any companies. Assume I own them. I don't own this one. And these are just my personal thoughts. This is what I'm doing. This is how I play the market. This is how I see the market. If you should only do things that make sense to you. You should know why you're doing something. I mean, think about these things until they make sense or don't make sense to you. Because that's what it's like. My philosophy is, yes, you again with let's say, talking about stocks, etc. It's like, yeah, those are fishes, but it's like, what's the saying? Give a man a fish, he'll eat for a day. Teach a man how to fish, he'll eat for life. I mean, I don't know how long I'm gonna be making YouTube videos, for example. I enjoy the investing theory a lot, and I enjoy doing these kind of educational videos more than a lot of other stuff. That's why it soaks up so much of my time. But I just enjoy that. And it's like, I hope some people get something out of it, because I think once you start to get all these psychological things and how a cyclical market behaves, that it is like Pong and will forever be like Pong and all that. I mean, it's like, personally, I don't see. I think the markets are kind of boring, because it's like, you're gonna win. In a broad sense, you're gonna win. It's gonna turn into a bull. So that's why I can play computer games in the meantime. It's just there's nothing to it. It's just waiting. The only part left is waiting and buying. That's the only thing. That's the only thing that makes sense. And forever has made sense at extreme lows. That's just how it is. But most people will never ever get it. And they will be very upset, very concerned, thinking that something is wrong, that they did something wrong if they're at a big paper loss or whatever. They refuse to buy more, they'll probably sell out, and then they'll just go into another sector, repeat the exact same mistakes, and never once in their life buy low. And of course, the reason I can afford to have big corrections is because I always ramp up my buying the cheaper it gets. I cannot afford these kind of dips if I don't invest increasingly so at the lows. Then, I mean, thankfully some stock picking as well, because if I just did that in Bear Creek, I would actually have to time my exits, and I'm not good at that. I'm good at buying cheap. I'm not good at selling, and I've been asked about that before. I'm not good at selling. So it's like, in a sense, me being all in is the best protection I can have for being a bad seller, because if I want to buy something, it means I think something is cheaper relative to what they have right now, or what I think they're gonna have in the future. And how do I get money? Most of the time it's to sell something. Might be if I own it, it's selling something I'm bullish on, but not as bullish on as the other thing. So it's like the kind of profit taking, or I mean, nowadays is not even too much of a case with profit taking, but it's like, I'm selling something that I at least consider less of a buy than what I'm buying. So naturally, that means that I am forced to high grade my portfolio by value shuffling. Because your portfolio should always have the best ahead. You should always be excited about what your companies you have might do, especially from the prices you're paying for them, especially right now. Yeah, thanks for listening. Bye.